All right, here we go. Gonna go live and walk through some thoughts. Got a few things I'm thinking about. Strike IPO today. We got some understanding of what the pricing may be on the IPO. The Strike IPO was upsized from 250 million up to 584 million, which I think is likely the largest um, preferred stock upsizing ever to exist. What's up, Darren? First comment. Thanks for joining. I'm going to walk through this because a lot of people have asked about this, and I wanted to walk through a couple of things on how I think the pricing works, just to give some perspective of um, my understanding of capital markets and my thoughts on kind of what has happened with the pricing, just to give some people some understanding of how complex pricing these types of deals is and how impressive it is that all of this stuff is done within a week. So, um, what's up, folks? Everybody's in the chat. We got some people here. Cool. So I'm going to share my screen and walk through some of this stuff. What's up, Ben? We've got the whole squad here. Cool. I'm going to share my screen. Okay, so shout out Blake. He followed up on my poll that I put out today. I was curious on what people's thoughts were on, how much capital MicroStrategy would raise from this Strike IPO. So going from the target offering of $250 million up to what we now know is about $584 million raised from the Strike IPO. So initially, the pricing on the Strike IPO was $100. So that's what MicroStrategy had gone to market with. So MicroStrategy went out to the market and they said, "Hey, market, we've got this product we want to sell you. Our IPO price is $100. The dividend yield, the fixed dividend yield that we're going to give you is 8% on that $100, and XYZ structured terms that we went through on True North last night." The market came back. There was market feedback, and the offer was priced at $80. However, with the market, with that offering being priced at $80, there was a significant increase in the amount of capital that was invested at $80 as opposed to the $100 original pricing. So I'm going to walk through my perspective on how I think that went, just so people can understand, I think, how complex this is, and how difficult it is. So I've walked through, or I've designed and created a example proxy structure here. Let me see if I can make this bigger. No, I don't want myself bigger. There we go. Okay. Example proxy pricing structure. Let's make it a little bit bigger so people can see it. And trying to outline, again, how complex this is. So when in other traditional capital markets, at least particularly in reinsurance, like when we go out to the reinsurance market with a deal, like a big capital deal, like if we need to raise $100 million of reinsurance capital, we'll go out to the market and we'll ask the market for quotes. So, we tell the market, "Hey, we want to get this $100 million tranche of risk. Give us your best quote. Like, what do you like? How would you price this $100 million tranche of risk? And what would what are the terms that you need in order to participate on this deal?" And all of the deals in the reinsurance market are syndicated. So we kind of like slice and dice all the quotes. We figure out what the market clearing price is, and we try to push the market as hard as possible to get the best terms and the best capacity to basically clear the deal. I think it works very similarly in this IPO scenario. So I think MicroStrategy went to the market with Strike with the target terms of $100, a yield of 8%, and the yield dollars per share of $8. Again, this yield number is a fixed yield. It is a fixed yield regardless of what the price of the underlying stock is. So that dollar number is really the yield that people are focused on. not necessarily the percentage, because if the price goes up, the yield percentage falls, the dollars stay the same. Hold on one second. Sorry about that. So the yield number will move around. The yield dollars will stay the same. So what I think has happened is, MicroStrategy went out to the market. They're like, look, we want to raise $250 million. Let's get some quotes from the market on how much capacity we can get at this pricing. The $100 price, 8% yield, $8 yield per share. And so they were looking to raise $250 million. So I put together some examples of how I think this works. So let's say BlackRock, right? So BlackRock may have come back and said, hey, MicroStrategy, we'll give you $75 million at your quoted terms, right? Your $100 quoted price, a quoted yield of 8%, and a quoted yield dollars of $8. That would result in 750,000 shares. But then BlackRock also said, hey, guess what? Well, I've got a little bit more capital that I'm willing to deploy to this, but you need to make the terms a little bit sweeter for me to give you this extra capital. So they said, okay, well, at a price of 80, we'll give you $100 million. Now the quoted yield is 10%, but the quoted dollars is still 8. But BlackRock gets a lot more shares than they would have gotten if they would have, quoted the price at, $100. Additionally, in this example, maybe they made it even sweeter and they said, okay, we'll give you $150 million for a quoted price of 70, which would be a yield of 11. And, because the market is trying to figure out how to price this thing. Nothing like this has existed in the market before. This is like a Bitcoin-backed preferred stock. So I think there are a lot of markets or capital out there that's trying to figure out exactly how to price this. And there's no proxy. There's no good comparison. So I think there were multiple quotes that were given by these capital markets. So then I give another example of Invesco. And this happens all the time in reinsurance markets where you'll go out with structure terms. Let's just say like these strike structure terms that MicroStrategy went out to market with. And then the market is just an asshole sometimes. And they come back to you with terms that you didn't even ask for because the market sometimes knows that they have power, right? So in this case, Invesco, again, these are just examples and ideas. Maybe Invesco came back and said, we'll give you $50 million at a higher price. Instead of 100, we'll go even higher. We'll go 110, but the yield needs to be higher. Like I need $10 of yield instead of $8 of yield per share, which might be a quoted yield of 9%, but they get a higher dollar value. So again, what I'm trying to illustrate here is like these terms, the yield percentage and the dollars, they may like move. And that may be a function of how the capital wants to deploy in this marketplace. And every single company may have a different pricing curve or a pricing mechanism that will be a function of how much capital they're able to deploy on these particular deals. So in the second example, maybe Invesco said, all right, well, 50 million at your quoted pricing, but I need a yield of 9% and I need a quoted yield dollars of $9. So you're probably starting to understand or see how complex this may be for MicroStrategy or honestly the brokers who are trying to place this deal as the terms may be different. And as you go down this pricing curve, right? So the quoted price going down from 90 to 80, maybe they can get to the yield dollar terms, but only if the quoted price is lower. So, and maybe the capacity increases as you drop the quoted price down from 100 down to 80 and get to the yield terms that the that MicroStrategy is trying to target, that $8 per share, or the $8 yield number. So then I put a couple other examples in here, like Fidelity institutional. Maybe the institutional buyers at Fidelity said, okay, we'll give you $50 million at your requested terms, and maybe $100 million if you go down to 80, something like that. And this is Fidelity possibly having a little bit more information than the rest of the market, knowing that they have some pricing power and pricing pressure here to bring the price down below par, because nothing like this has ever existed before. And there's no incentive to really price the stock above what the pricing terms are, depending on, market feedback, et cetera. Then this Fidelity retail line here, retail is retail. So retail they have no pricing power. They have no quoting power. Retail just, gets the terms that were offered by MicroStrategy. There's no, retail is not coming together and, changing the price of the terms for their access and IPO. And looking at these last options here, so just, throwing together again how confusing this whole process is and how challenging it is for the brokers that are placing this deal, is you have all of these other capital providers that are coming in, right? You're going to have like VanEck and family offices and Allianz and Berkshire all coming in with different pricing and terms. Again, this is very similar to, I'm guessing this is very similar to like how large capital is priced in the reinsurance market, where, some of these larger institutions like BlackRock and Invesco and Fidelity, they may provide multiple quotes, but then you may have some of these smaller shops that only provide one quote. And it's like, okay, here's the capital that we can provide. Here's the pricing we can provide. Take it or leave it. If you like it, great. If you don't, no skin off our backs. And so in these examples, I've got VanEck in here, $100 million, but only at a price of 80. I've got these family offices that they came to the table at the MicroStrategy terms because they don't know any better. Allianz coming in, thinking they have some pricing pressure, $49 million at a quoted price of $80. And then Berkshire, just a classic Berkshire. Again, and this is just illustrative. These are not real numbers. This is all illustrative. I'm making all of this up, making 100% of this up. So don't think this is fact. But Berkshire always likes to play hardball, at least my experience with them. And in this illustrative example, maybe Berkshire comes to the table, but they'll only do it and they'll drop $250 million, but at a quoted price of 50, and a quoted yield dollars of $6 per share. So a 12% yield. So just coming out of left field with just a massive slug of capacity at just different terms, just because they know that they have power because they're Berkshire. So what the broker does, or I guess the underwriter does in this process, is they look at all of these quotes, and it's likely significantly more complex than what I have outlined here. And they say, okay, well, they'll say, okay, let's sum up all of the capacity at a price of $100. So you look back up in all of these terms and you're like, okay, at a price of $100, we could get 75 million from BlackRock, 50 million from Invesco, 50 million from a retail, and I missed one here, and 50 million from Fidelity Institutional, 25 million from Family Office 1, and 40 million from Family Office 2. So in this scenario, maybe MicroStrategy were to clear $290 million, again, just illustrative. Maybe they were to clear $290 million of capacity at their target $100 initial offering price. However, looking at the rest of the quoted prices, you may see, well, how much worse off is it if we drop the price to 80 and we're able to increase our capacity from more than double our capacity, or effectively double our capacity from 290 million to 584 million by dropping the price by 20%. And that's where this analysis or the job of the broker comes in, the person that's placing the deal. And so in this illustrative example here at $90 at a $90 per share price, summing up the capacity at $90 or above, right? Like if anybody priced it at 100, if you finalize the price at 90, you're getting everybody that priced it at 100 because they're getting a better deal. So in this scenario, I'm summing up BlackRock at 75 million, Invesco at 75, Fidelity Institutional at 50, retail at 50, both of the family offices, but still, Van Eck is out, Allianz is out, and Berkshire's out, obviously. So then you get to the price of 80, and you look at this example and you say, okay, well, at 80, I get another slug from BlackRock. I'm going to get another $25 million slug from BlackRock. I get a bigger slug from Invesco, a bigger slug from Fidelity. I know I've got retail. Van Eck comes in the door at 80. They weren't previously in the door at 100 or 90. You got both of the family offices, and now you can sneak in Allianz. So you've got more capacity. You've got more potential owners that would buy the stock at 80 at these terms, just because you're, changing and altering the price to get that additional capacity. And then in these other examples, you see that this is Berkshire effectively makes this a cliff, right? Like at a price of 50, maybe there was, significantly more capacity. Like maybe they could have issued $880 million of strike shares. However, they didn't want to drop the price all the way to 50. Maybe that's because of market sentiment, or, we think that, we're going to be able to ATM this at some point in the future. Like who knows what the decision-making is, but that's part of the decision-making process that MicroStrategy likely had to go through in order to price the deal. They probably would have been able to price strike at $100, but there was likely just less capital that came in at $100. And there's this kind of like bang for your buck, push pull when you have different prices. Bobo, you want to make an appearance? We've got Bobo. Bobo came in to make an appearance. Do you want to talk preferred stock? All right, you can go to sleep. Go to bed. Anyway, so I think additionally there was a bit more. It sounded like there were a couple questions on how the dividend from the preferred stock would be treated. I think there was some questioning on whether it would be treated as a qualified dividend or a return of capital. And depending on the type of dividend it is, results in a different tax treatment. So that, I think there's some uncertainty on exactly how that's designed. So that could have led to some additional, different thoughts and pricing. A couple other things that I was thinking about is this is, people have talked about the pricing going from 100 down to 80 being bearish. And I really don't think it's bearish at all. I mean, there's no other product that has existed like this in the market before. I mean, MicroStrategy raising $584 million of capital in a week from a completely new capital pool, a completely new trading partner that's pricing a deal that's never been priced before, and it just got upsized by 230%. I don't think that's bearish. And additionally, like that capital, like you want MicroStrategy to bring more capital in the door because that's more capital is going to be buying Bitcoin permanently held on balance sheet. And these buyers aren't the type of buyers that are like the convertible debt buyers that are going to be shorting the stock instantly right away. And they just have a different way of holding this equity. So I think that's all I got really on this. Going through the pricing process on, whether it be reinsurance or preferred stock or IPOs, is incredibly complex, right? You've got so many different buyers with so many different perspectives on price. when you're entering a new marketplace like this with a new product that's never been priced before, obviously preferred stock has been priced before, but like with this type of exposure, everybody's going to have a different perspective on what it's worth, and that results in, you know, disagreements on value and changes in estimated price. Potentially in the future, well, I guess since it's IPO'd, if MicroStrategy can now use the ATM. Let's say the stock strike hits the secondary market, and it turns out there's actually a ton more capital, retail, secondary, that just wasn't able to access the IPO quick enough. We could see the price of the stock go to 100 or 120, and then all of a sudden, MicroStrategy may have the ability to use the ATM and issue preferred stock, and, you know, generate even more accretive capital to buy more Bitcoin to put on the balance sheet. So, yeah, it's a really interesting product. I do not envy the people that had to go through the pricing process here, but I would have loved to have been a fly on the wall and see how this goes, because I think I'm pretty close, but it was likely significantly more complex than this. Okay. What else did I want to hit on? Oh, reinsurance. Also wanted to talk about reinsurance a little bit. So, oh, that's my video. Okay. So reinsurance, I wanted to talk on this. State Farm blows through their reinsurance cover with $8 billion in LA wildfire loss. This is a really big deal. Companies generally don't blow through their reinsurance towers. Reinsurance towers are generally designed to withstand a 1 in 250 year return period loss, which is a 0.4% chance of a loss in any 1 year. And now you have a really large company like State Farm that buys, you know, a significant amount of reinsurance, blowing through their entire reinsurance tower in a 0.4% event. I mean, it maybe less for State Farm. Like all these companies have different risk return metrics and ways that they buy their reinsurance. But this is a really big deal. It's reinsurers don't expect to have entire reinsurance programs blown out the top of their reinsurance towers. That they price for it, but it's an incredibly low probability. And so when you have a situation like this, the reinsurer now has two options. I will also say that all of these big reinsurance transactions are super heavily syndicated. So you may have like 40 reinsurers on the State Farm tower, like probably more. There's probably 100. There's probably 100 reinsurers on the State Farm reinsurance tower. And, you know, having an $8 billion loss, you just tattooed all of them, right? Like you just absolutely crushed all of them. So all of them are going to have a big loss to their participation on this specific State Farm tower. Now, just as if you were to get in a car accident and total your car, your insurance company would pay for you to get a new car, but your car insurance rates would go through the roof because you just totaled your car. Very similar thing happens in the reinsurance market. State Farm just totaled their car. And since they have totaled it, when they go back out to the market next year, maybe 10 to 20 of their reinsurance partners just walk away from the deal. And or they say, hey, we'll provide our capacity for 2025 or 2026, but we have to exclude wildfire. Like we can't include wildfire anymore just because like you guys can't tattoo us 2 years in a row. Like I'm bankrupt if you tattoo us 2 years in a row. So this is a really big deal because it reduces the supply of reinsurance for State Farm. And there's also pricing pressure, both to increase the retention. So you could think of like a deductible for primary insurance, and increases the retention and the deductible for the reinsurance company or for State Farm. So let's just say maybe State Farm had $1 billion deductible in 2025. In 2026, it might go from $1 billion to $3 billion. And maybe their tower exhausted at 10 billion, and now it goes from 10 billion to 15 billion. But the pricing on that capacity to reduce that volatility, maybe it cost them, I don't know, $1 billion a year to buy $8 billion of limit, and next year it'll cost them $2 billion or $3 billion. And that has a significant impact. You've got two moving pieces, right? You've got the deductible. The deductible that they have on their entire reinsurance tower is likely going to expand, so go from 1 billion to 3 billion, and the price on the amount of reinsurance that they buy is likely going to increase by, I don't know, 50, 100, 200% potentially. So what does that mean? It means there's likely going to be pricing pressure on State Farm policies, and it's likely going to be nationwide, everywhere, because if State Farm, think about the process here, right? Like if State Farm were to try to pass this, pass the cost of this only on to California insureds, all of the other competitors in the area, Farmers, Allstate, Progressive, whoever, is going to be able to beat them in pricing. So the only way that, this company continues to remain competitive is they have to spread that cost everywhere across their entire portfolio. The increased retention, which has an expected loss component, and the increased reinsurance costs, which they're going to pass on to all of their insureds. So this is just one example, and State Farm, I think, may have one of the larger losses in the market. It sounds like this industry loss may be around $50 billion. I think there's potential it could be a little bit bigger. Just kind of depends on so many things. How the state gets involved, whether or not utility companies are deemed liable for the loss. And if utility companies are deemed liable for the loss, then the insurance companies are going to go subrogate against the utility companies, and there might be a big loss on the utility companies from potentially having exposure to the Eaton fire. Politically, like if there's a huge supply crunch on materials or builders or engineers or any of those things, I suspect the insurance companies may start to run up against limits. So you have these insurance companies that, let's say you have a $2 million house or a $2 million policy, but because of the demand surge on builders and architects and all this other shit to build your fancy house, it may cost $3 or $4 million to rebuild it. So if it costs $4 million to rebuild your house, but your policy is only for $2 million, who pays the excess? And it's likely the homeowner would pay the excess loss in that circumstance. But I think this is going to get really political, and the state may try to step in and require insurance companies to pay an extended replacement cost, which is kind of what that's called, like a extended replacement cost, to capture some of that demand surge. So, yeah, I mean, there's a ton of challenges in the California market. I'll stay on top of it, of what's going on, but politically, it's getting really weird. I think there was just a bill that was introduced in California, not passed as law, but it was introduced, that was trying to pass the potential loss or allow insurance companies to potentially sue oil companies for causing climate-related disasters, which, as you can imagine, would open just an absolutely enormous can of worms. But unfortunately, I think there is a little bit of historical precedent with how the law is written in California with this this law called inverse condemnation. And inverse condemnation is this law that I think was written in like the 80s, 70s, or 80s. And it effectively, um, it puts utility companies like at fault for things that happen. So let's just say you've got a farmer, and you got a farmer in his backyard, and he's using a hammer, and there just happens to be a utility pole on his property. The farmer's using his hammer, and the farmer throws the hammer and hits a utility line and causes a spark, and it causes a fire. It's not the farmer's fault for throwing his hammer. It's the utility company's fault for having the utility infrastructure in your backyard. And that's the precedent that's been set for some of these utility caused wildfires in the past, like 2017, uh, Atlas Tubbs Nuns, in 2018 in Paradise. I think even the 2020 fire in Oregon, they use some similar precedent in California. So I can see this getting really tricky politically, really tricky legally. And there's a lot of loss that the state of California has incurred, and it's going to change the dynamics of so many things. And I suspect even in locations like these high value hills in Beverly Hills and outside of Hollywood, et cetera, a lot of people that own those homes are in a really sticky situation, because let's just say you've got a $20 million home in Bel Air, and all of a sudden you can't get insurance on it. And okay, so then what happens, right? Like, you have a $20 million home, you can't get insurance on it. One, do you even live there? Like, what's the utility? Like, are you using this house for utility? Is this your only house? If it's your only house, then it's really important to you. If not, like, what's the point of owning this house? Is it just a store of value, or, what's the point of it? And I think a lot of people are going to rethink the dynamics of owning some of these really high value homes in really risky areas, because if you can't get insurance, or nobody's willing to provide you insurance, how do you, are you willing to pay, $500,000 a year, $1 million a year to protect your $20 million home? I don't know. That's a really tricky question. I think a lot of people are going to have to think about, and that may really impact some of the home values down in California in those higher value areas, because of their ability to get insurance coverage in those particular locations. And I think, somebody brought up MCY here, which is Mercury. Mercury General is an insurance company that is based in SoCal, and I think there's some rumors going around that they've hit their reinsurance tower. And for smaller companies like that, they I think Mercury's got a decent sized portfolio. I think they write some business, in the US, but I think they've got a really heavy Southern California portfolio. And when you have a loss like that, it really challenges your entire business model. Because if your costs of your reinsurance go up 400%, and your retention, your deductible of your reinsurance goes up 400%, and you have to compete against the likes of State Farm and Farmers and Allstate and all these other companies that don't have that same loss, or they've got a bigger diversified pool of exposure in Florida, Texas, and Northeast, or whatever, your business model gets challenged really quickly. And I think it's tricky to drop all this business that you've previously, has been core to your company, and, flip and revert and start writing business in other states and locations that you've never written before, just to try to, keep your business alive. So I think there are some companies that are going to be challenged moving forward. I think this market's just so interesting. It's all playing into, all of this capital moving in different locations, and all kind of ties into Bitcoin a little bit too. So that's all I've got. I think I've talked enough, and about 35 minutes. Thanks for joining. Appreciate it, everybody. Wow, 3,300 people. Cheers. Have a good night.